Hello traders and investors, this is Sal for Expo Futures, and I'm going to briefly introduce you to a call ratio trade, which is a very flexible trade for anybody trading in these volatile markets. If you want a short premium because we believe in time decay, but you're worried about the risk, the call ratio is a good tool to have if you're already trading options on margin on the short side. So if you have ever done a strangle or shorted a call, and the setup I'm going to use for example would be this crude oil that I'm using here. If we think we're bearish, for example, or we don't think it goes up, we can look at options to short where we don't think it'll hit, right? And just collect the time decay. So let's say we wanted to put on a trade in this 90 level because I've already priced them out, but I'm now trying to decide what am I going to put on. I want to sell upside. How do I put on the trade? What makes sense? Okay, so let's go back to our diagram. And what I'm showing you here is a call ratio for a net credit. This is a risk profile of this trade where instead of just shorting one call, and that would be like selling the 90 on crude oil because it's in the 77s, we're going to sell two of them. We're going to use the extra premium to buy a call for protection. Now, this can be a bullish trade or it can be a bearish trade depending on how you design it. You can still do a 1x2. The width between the two strikes will determine if it's slightly more bearish or slightly more bullish. But what you're doing here is you're basically buying a call and selling premium, so you're more short than you are long. When you do this in a bearish way, you're actually collecting an initial credit, and that's what I'm showing here in this risk profile. The risk profile is based on price and your losses and profits. Profits above, losses below. So I'm going to go over this. The rest of the video will be how to read this risk profile. So if crude oil in our example is at 77 and around 78, that's the at the money price. These would be the example of all the different strikes. I'm going to go back to my fire tip platform. Crude oil is at 77 right now. It's been a little bit higher, 77.5, almost 78. So I'm going to sell these 90, 92 calls. I could sell the 90 or I can sell the 92 for 53 ticks or 42 ticks, whatever the going rate is. If I want to do a ratio, I can combine by buying one long and selling two 92s. Buying one 90 and selling two. So instead of just collecting a certain amount, I'm going to double up on the short and have a little more long. I'm going to use that as protection, and I'll show you why. The way, if I do it that way, I'll end up having is a long option at strike A, and I'll be short two options at B. Now, all I'm really looking to walk away with is the credit, and as long as it doesn't rip up against me quickly, I have a shot at having a little extra bonus in this middle. That middle is the short premium we're collecting from the two strikes, and then the long option we use as protection. Okay, so that gives us this risk profile. If the market goes against us, this red line shows what happens as the price goes up. So here's the crude oil price. Price goes up, it's going against us, we take losses. At expiration, once those short options expire and they decay, we actually get a chance at the profit because we're long a call, this call right here, the strike A, and I'll show you. I'll select it, strike A, and we're short two of these other calls. So if those two shorts go away, we're left with profits. Now, if it goes down, crude oil just goes down or stays where it's at, we end up only getting the credit, which is fine with us. We don't need to have the additional profit. It's nice to have it. Now, if you're comparing it to a short call, guess what? You're getting the same credit, but you don't get the chance at a potential profit. You just get the initial credit or the losses. So the way I would explain it is, in a ratio, you have a shot at making a little extra if it goes into the sweet spot. If you're just naked a call, you're just going to stress out and take losses. So it's more stress. In a call ratio, you have a shot at a bonus. Okay, so this is a brief overview. I would pause this video and go over it. One twist on the call ratio is this additional long call, and then it becomes more like a butterfly or a broken wing butterfly. It's also called a skip step or skip strike butterfly, which caps the losses, so you stop losing at this lower line here. Okay, I forgot to mention here, at expiration you get the max profit if it stays at where the second strike, the short two calls, are. And then you have an additional break even at expiration, because these gains that you're making from the long call carry over to reduce your losses. So you're long here, one option, short the next strike, two, and then the profits from the long will wash the loss on the two calls up to this point. So there's no longer any benefit to staying in the trade past the last break even for expiration. You're just going to take losses. So there are different ways to manage this, but I'm just going to introduce how to read the risk profile for a call ratio for a net credit in this video. Have a good day, and if you have any comments, leave them below or send us a message. Take care.